Hello traders, welcome to our different segments or concept of prime forex trading class. In this video, I will explain one of the basics of forex trading, supply and demand zones. The principle of supply and demand are the backbone of all market activities. When it comes to trading, these laws play a vital role in determining price movements. But what are these levels and how can you use them in your trading? Let's dive into it. But first, let me introduce myself to all of you guys. My name is Donovan and I've been trading as of prime forex and I've been experiencing trading for 9 years. I also put some disclaimer that all information is being presented for educational only purposes, and information in this video should not be construed as containing investment advice or investment recommendations. What will be discussed? What is supply and demand zones? Why they matter? The type of supply and demand zones? How to identify supply and demand zones? The supply and demand zones indicators, how to draw supply and demand zones, strategies to trade supply and demand zones, and the last is the pros and cons. Okay, today I will break it down one by one for you. Please do not forget to prepare your notes and pen. So, what is supply and demand zones? First, supply and demand zones are specific areas on the chart where price is likely to change direction due to shifts in market sentiment. These zones emerge when there is an uneven balance between buyers and sellers in the market, leading to significant price movements. They are characterized by a noticeable surge in buying or selling pressure, creating distinct levels on the chart. But wait, I think you need to understand the basic idea of supply and demand trading first. The basic idea of supply and demand trading. Traders often seek trading opportunities when the price of a financial asset approaches supply and demand zones, anticipating potential reversal or continuations. The price of a currency pair rises with high demand, more buyers than sellers, and falls with high supply, which means more sellers than buyers. This principle forms the basis of trading education programs and is a fundamental concept in the forex market. After you know the basic idea behind supply and demand trading, you might be questioning why does it matter in trading? Here are some of the reasons why they matter in your trading. First, they act as market turning points. Zones mark potential price reversals or continuation based on supply and demand imbalance. Traders use them for precise entry and exit points, bolstering informed decisions. Next is market sentiment indicator. Zones reflect shift in sentiment. Demand zones signal strong buying interest, potentially causing price rises. Supply zones indicate excess sellers, possibly leading to price declines. Traders align with prevailing market forces. Next up is pattern confirmation. Zones validate technical patterns like trend lines and candlestick formations. Confirmation boosts traders' confidence in setup. Next, it is used for risk management. Zone 8 risk definition. Placing stop loss order near zones limit losses, leveraging the support or resistance effect. Fifth is trading timing. Traders wait for price in zones to match sentiment, enhancing trade timing and success probability. And lastly, the institutional influence. Institutional impact zones affecting prices. Identifying zones allows retail traders to anticipate and benefit from institutional participation. The main types of supply and demand zones. The supply and demand zones are divided into two types: reversal patterns, and continuation patterns. Okay, let's break down these two types of supply and demand zones. First, reversal patterns. Reversal patterns signal a change in the prevailing price trend, either shifting from an upward trajectory to a downward one or vice versa. To better grasp these patterns, let's explore two distinctive structures. First, drop-based rally. Here, the price experiences a downward movement stabilized around a particular price level to form a base structure, and subsequently undergoes an upward rally. Second is rally-based drop. In this structure, the price rallies upwards from a base structure and then undergoes a significant downward movement. Continuation pattern. Continuation patterns denote instances where the prevailing price trend persists in its current direction, whether upward or downward. These patterns are generally regarded as weaker, often experiencing breakthrough. To grasp the concept of continuation patterns more comprehensively, let's explore their two distinct types. First is drop-based drop. In this structure, the price initiates the drop, takes a pause to create a base, and subsequently continues its downward trajectory with heightened momentum. Second is rally-based rally. In this structure, the price rallies upwards, pauses to create a base, and then resumes its upward trajectory. Now, let's go a bit practical and learn this step by step to identify the supply and demand zones. How to identify supply and demand zones in trading. Step 1. Understand market imbalance. Market imbalance are the catalyst for significant price shifts in specific direction, either upwards or downwards, based on supply and demand dynamics. Step 2. Spot the current price. Begin by locating the current price on the chart. Direct your attention to the left side of the chart and identify a sequence of robust, distinct candles that are either ascending or descending. Typically, supply zones are indicated by preceding robust upward price movements, while demand zones are marked by preceding significant downward price movements. Step 3. Find ERCs. Extend range candles. Proceed to research for ERCs, which are characterized by their extended bodies with minimal or no wicks. Remember that if a candle possesses equal-sized wicks and body, it is usually not classified as an ERC. Step 4. Identify origin of price movement. Conclude the process by identifying the origin of the price movement on the chart. As depicted in the chart example, observe a price rally accompanied by candles of smaller sizes. Subsequently, note a pause in price movement for the duration, followed by a significant downward drop characterized by multiple ERCs. This point of origin serves as the foundation for forming the base of the supply zone. Establishing this base is instrumental in accurately delineating the supply zone. Cool. Now that you have learned about how to identify supply and demand zones, let's go to the indicators to help you trade supply and demand zones. First, we got pivot points. Daily or weekly pivot points are widely employed by traders to identify potential supply and demand zones, also known as resistance and support levels. This technical analysis indicator calculates an average of the previous trading day's high, low, and closing prices. 2. Support and resistance. The concept of support and resistance play a crucial role in comprehending and assessing chart pattern. Support signifies price levels where downward movement halts due to increased demand for an asset. Conversely, resistance delineates price levels where upward price movement reverses, typically accompanied by a sell-off. Fibonacci levels. Fibonacci levels aid traders in recognizing potential turning points within supply and demand zones. As demonstrated in the chart below, the 61.8% retracement level from the Fibonacci sequence unveils the significant supply or resistance levels. Moving averages. Moving averages are versatile indicators that help traders identify trends and potential support and resistance zones. When the price interacts with moving average, it often reflects a zone of potential buying or selling interest. Volume profile. Volume profile analysis offers insights into the concentration of trading activity at various price levels. Peaks in volume at specific prices can indicate the presence of significant supply and demand zones. Bollinger Bands. Bollinger Bands encompass price movements within the upper and lower bands, aiding in identifying potential overbought and oversold conditions. Price interacting with the bands can signal potential reversals at supply and demand zones. Ichimoku Cloud. The Ichimoku Cloud indicator offers a comprehensive view of support and resistance levels. Price movement within or above the cloud can indicate potential zones of buying or selling interest. ATR or Average True Range. ATR measures market volatility and can help traders identify areas where price may experience significant movements, often indicating supply and demand zones. Now, we'll talk about drawing supply and demand zones. There are three approaches to drawing supply zones. First, the conservative method, 2, the high risk method, 3, and the low risk method. As for the conservative method, place the first line at the top of the wick of the highest candlesticks. Let's say the base of candlestick. Position the proximal line or second line at the base candlestick's body's low. High risk method. Set the distal line at the highest wick of the base candlestick and then position the proximal line at the lowest wick of the base candlestick. Low risk method. Place the distal line at the highest wick of the base candlestick and position the proximal line at the base candlestick body's high. Now, we will learn about the drawing of demand zones. There are three of the methods. First is conservative method, high risk method, and low risk method. For conservative method, we can place the distal line at the lowest wick of the base candlestick, and then position the proximal line at the base candlestick body's high. High risk method. Set the distal line at the lowest wick of the base candlestick, and then position the proximal line at the base candlestick highest wick. Low risk method. Place the distal line at the lowest wick of the base candlestick and then position the proximal line at the base candlestick's body's low. Now, let's go into the real deal of supply and demand zone strategies that you can implement. Effective supply and demand zone trading strategies. The first one is range trading strategy. Utilize well-defined supply and demand zones to implement a range trading strategy. Use indicators like stochastic oscillator to identify overbought and oversold conditions. This non-directional approach allows you to spot long and short interest based on the identified zones. After analyzing the conditions on a longer-term chart, zoom into a short-term time frame for precise entry points. Second one is breakout strategy. Take advantage of price fluctuation by employing a breakout strategy. Look for opportunities to enter the market when price breakout of a narrow trading range, potentially signaling the beginning of a new long-term trend. However, be cautious of false breakouts, where prices quickly reverse back into the supply or demand zone after the breakout. Third one is risk management strategy. Supply and demand zones not only indicate entry points but also offer valuable information for risk management. Set stops above supply zone or below demand zones to counter potential losses. This approach is especially useful for range traders, as they can limit the risk and aim for profit spread towards the opposite zone. Here are some of the laws or rules of supply and demand that you need to pay attention. First is time. The longer price remains in a zone, the stronger the supply or demand at the level. Second is strength. The speed and sharpness of price movement away from a zone indicate the strength of supply or demand's imbalance. Lastly is freshness. Zones that have not been revisited since formation are considered fresher and likely to yield stronger reaction. Here are a few pro tips to better trade supply and demand zones. First, you need to combine with technical analysis. Integrate supply and demand insights with technical analysis for a comprehensive trading approach. Next, you also need to prioritize risk management. Limit risk 1 to 2% of capital per trade for account protection and strategy refinement. Next is tolerantly strong imbalance. Focus on pronounced supply and demand imbalance for higher probability trades. Next is to utilize longer time frames. Start with daily or weekly charts to reduce noise and enhance clarity. Lastly, confirm with indicators. Use indicators like volume, RSI, and moving average for added confidence in supply and demand analysis. So, it's important to remember that supply and demand zones trading have some drawbacks as well that you need to be aware of. Let's uncover the pros and cons. Let's start with the pros. First is simplicity. Intuitive and based on fundamental economic principle of price determination. Second is applicability. Suitable for all market involving buying and selling, making it versatile. Third is predictive. Offers insights into potential future price movements. Lastly is risk management. Provides clear entry, stop loss, and profit levels for effective risk control. Now for the cons. First is subjectivity. Identification of zones can vary among traders due to lack of standardized definitions. Next is market noise. Small price movement within zones can lead into false signals. Lagging. Relies on historical data may not always accurately predict future price changes. Lastly, your patience is required. Demands waiting for price to reach defined zones, testing traders' patience especially in less volatile markets. That's a wrap. Well, that was our discussion about supply and demand zones trading. Hopefully you can more understand and implement this strategy. I'll see you in the next class.